It's 6 o'clock in London. It's 1 p.m. in New York, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world today. My name is Patrick L. Young. The IPO-VID Livestream, Series 16, Episode 3, which adds up to a grand total of Episode 93, starts here. Gosh, there's been a sticky post-trade situation this week in the world of exchange-traded derivatives. Hackers being paid off and Ion Group embarrassed by a hack which will more likely than not, I suspect, lead to greater cybersecurity across the world of exchanges and derivatives. I do believe, and in fact probably our expert may be the man to ask about this in just a moment, the delay in the US CFTC commitment of traders report, I think may actually be unique. The first time that's ever happened, simply because all manner of brokers and intermediaries ended up being sent back to about 1983 as they were trying to input their data. Meanwhile, we had a lot of encouraging results across the parish of exchanges this week. All were in Exchange Invest, the newsletter of the Bourse Business. Particularly interesting to see very good numbers coming out of SIBO and also plaudits to MCX India. Finally, this week for our opening remarks, I'm absolutely delighted to see the 2023 FIA, that's the Futures Industry Association's Hall of Fame honorees being named. They're going to get their awards in Boca Raton in the middle of March. Hopefully we'll have a chance to chat with at least one or two of them when we're there for the conference in the middle of March. Particularly delighted to see that, well, the late Nick Carew-Hunt, it's such a tragedy he won't be able to elucidate and amuse us in person, having passed away just last week, but great to see him being honoured by the FIA, amongst many others, and particularly pleasant for me. I'm so pleased to see my good old friend, digital trading pioneer, longtime broker, the man who in many ways presented that great paper at an AGM that explained why the CME, the Chicago Mercantile Exchange Group, was going to go electronic way back at an AGM, good grief, 20 years ago and more. James Olaf, I'm looking forward to seeing you and toasting your arrival in the Hall of Fame. It's a richly deserved plaudit. Now, our guest today, I don't think he's made the FIA Hall of Fame yet, but there's every reason to presume that he's going to be there imminently. Craig Pirrong, the Streetwise Professor, is speaking this evening. Dr. Craig Pirrong is Professor of Finance and Director of the Global Energy Management Institute at the Bauer College of Business at the University of Houston, best known in markets by his moniker, the Streetwise Professor, digesting financial and particularly commodity futures data and producing fascinating bite-sized nuggets, as well as much longer pieces of research that have us all thinking. Craig, welcome to the show. It's absolutely a joy to see you here today. Where in the world are you?
I am in Houston, Texas, one of the time zones that you didn't mention in your tour around the world. So.
Yes, we didn't quite get there. I'm terribly sorry for that. All those people who are trading oil must be deeply offended. I'm terribly sorry for that. So tell me, Craig, nowadays we know you as the Streetwise Professor. How did you get into being so fascinated by markets?
Well, so I was a PhD student at the University of Chicago, and I was having a difficult time finishing my PhD thesis on ocean shipping, of all things, because I was having a hard time getting data from shipping companies who are very, very sort of anal about their information. And a guy named Fred Arditi, who had served, for whom the Arditi Prize at the CME Group is named, was president of FCM, Futures Commission Merchant in Chicago. He was a former academic. He called my thesis advisor and says, "Hey, I'm looking for somebody to do research for us." And my thesis advisor said, "Well, Pirrong's not doing anything. Why don't you contact him?" And so Fred called me. I went to work for this FCM. Shortly thereafter, my data for my thesis came through, so I had a day job with the FCM and a night job with the finishing my thesis. And not to date myself, but I was having issues with my boss. And Fred by that time had gone, and then so I had gone to the head of the FCM, and I said, I'm having problems with my direct boss, and tried to work it out, didn't work it out. So on the morning of October 19th, 1987, I slapped down my resignation letter about a half hour before the market opened. And so now you know why the crash happened. And then I went into academia sometime after that. And then right after that, and this is the sort of the real pivotal point, was Ferruzzi, the Italian company, tried to corner the soybean market in Chicago. And through a series of coincidences and connections, I got involved in studying that and making recommendations to the Board of Trade as to how to address these sorts of issues. And that just took me all down all sorts of rabbit holes. And believe it or not, led to my work on electronic trading, on exchange governance, and all sorts of things.
Wow, that's an incredible arc of history you've managed to go through there in one go. Actually, it's very interesting. Maybe that's something like the butterfly effect, but at the moment you slapped down your resignation from an FCM in Chicago, I was actually being employed by an FCM at interview in London on October the 19th, 1987. Can't think of anything else that happened that day. Those are obviously the two most memorable events that took place on that particular one, although I'm not sure which one of us deserved the epithet Black Monday. It's probably you, because of course you were lost to the brokerage business in the future. So I'm here, we're talking to the Streetwise Professor, Dr. Craig Pirrong. Thank you very much, everybody who's been commenting on social media. Particularly thank you, Chris Messina of the Messy Times. I saw your remarks even before we went live this evening. Really appreciate it. Yep. Hi, Chris. It's great to see you all together. This is going to be a kick-ass discussion. Patrick and Craig are both sharp as tacks about markets, are original thinkers, and rely on data, not supposition. Thank you very, very much, Chris. That's a real pleasure to see you. Hi there to Peter Secon and John T. Good evening all, says John T. Lovely to see you this evening, John. Hello as well, Peter Secon. Hi there, Peter. Hope you're well. Hope you're sitting on the sofa with Ari watching us this evening. And Les Calvert, great to see you as well, Les. Hope everything is going well in your world and you're managing to defeat the bureaucracy of the world as you carry on through the world of business, particularly in the UK. Les, hope all's well with you. Great to see you all this evening, gentlemen. Thank you very, very much. So, Craig, you returned to academia. Sorry, I just missed something. Did you go straight back? Did you go straight to Houston and stay there, or were you at other? No. Okay.
No, so I went to the University of Michigan. I was at the University of Michigan for 6 years. I didn't get tenure because of Hillary Clinton, but that's another story. That's literally true. That's literally true. Then I spent some time at Washington University in St. Louis. Then I was the Chuck Watson Professor of Commodity and Financial Risk Management at the Oklahoma State University before coming to Houston exactly 21 years ago.
Wow. And that's absolutely fascinating. I'm intrigued that Hillary Clinton would have ever been involved in denying anyone tenure who was an expert in financial market data, given the fact that she herself is the greatest futures trader who ever lived, according to her brokerage account.
Absolutely. So,
yeah. Impressive. Most impressive altogether. So fantastic. Houston. What's it been like? I mean, going to the University of Houston, you're in the epicenter of the oil business in every possible way. And that obviously led you to get a lot more involved in, presumably, energy analysis.
Yes, that's correct. And so again, sort of tracing back to Ferruzzi, that's what got me into commodities, and then energy being the biggest commodity. So I wrote a variety of things about energy markets, energy futures. So, for example, I wrote a paper, an article on the Metallgesellschaft and what caused its meltdown. Then I did work on electricity derivatives pricing and things of that nature. So part of the reason that I was brought to Houston, I was offered the job here, was because of the research that I had done in commodities generally and energy specifically.
Fabulous. Gosh, it's a trip down memory lane this evening, in particular, remembering the names you're just throwing out there. I mean, Ferruzzi and their infamous soybean corner, and also you talk about Metallgesellschaft, which comes from the middle of the 1990s, if I remember correctly, when we had a series of interesting scandals ripping through markets. It seems like almost every year there was something was going on there between Metallgesellschaft, the Sumitomo crisis, there'd been the Bearings fiasco. Quite fascinating altogether. Obviously, I mean, you got very, very close to the futures, options, derivatives markets. I mean, it's a very broad question, but you've seen incredible change across the board in the course of the last 30, 35 years.
Yes, and I mean, yeah. So the changes in many directions, dimensions, and the sort of the two most important, and I think that they're linked, are first of all the computerization, electronification of markets. I think I played sort of a small role in that evolution. I did some early research, on that in like 1994, 1995, looking at liquidity on DTB at the time versus life, and that study got some notoriety. So that would, and so I was sort of an early student of and sort of advocate of computerized trading, which for somebody from Chicago and who had close connections with the exchange is, that was not necessarily always very popular. And then the other related development was the demutualization of exchanges and the evolution of exchanges from essentially private clubs to for-profit investor-owned corporations.
Yes, it's been a staggering change in the parish of exchanges over the course of that time. And certainly so many exchanges today are quite unrecognizable. It's lovely looking back from now, because certainly so many people just come up to me and go, well, it was obvious that all of these things were going to happen, wasn't it? And well, I think you were on the front line as well. It was far from obvious that people were going to actually embrace change at different times.
No, absolutely, and that's where the sort of the DTB life story comes in. And so, another personal anecdote. So what had happened is that everybody was criticizing DTB for Deutschlandbörse for not having locals and not being as liquid as life, and that sort of the conventional wisdom that was that locals were the font of liquidity. And so DTB was investigating whether they should add a sort of an electronic local. And so they commissioned me through a think tank in Chicago to do an analysis. And one of the things that I did was, given the data that was available at the time, I did the standard sort of academic analyses comparing liquidity on the two exchanges. And somewhat surprisingly, so quantitatively, the markets were sort of equivalently liquid, even though DTB only had about a 20-25% market share at that time. And the study got a little bit of play. There was an article about it in Risk. There was an article about it in FT. And I remember, I think it was the CEO of Life. I can't remember his name. But anyway, either the CEO or chairman of Life said, oh, this is just an ivory tower academic study. Everybody knows that open outcry markets are and always will be more liquid. I literally made that bulletin board material, like cut out the article, put it on my bulletin board. And I was a very good boy that when I read some years later, after 1998, when that gentleman lost his job, not to remind him of what he had said. So it was definitely not the conventional wisdom at the time that markets were going to go electronic. And, some of the respects it might have been, sort of believing, your own propaganda or whatever. But the incumbents firmly believed, and this is partially because they were member-owned organizations where the people that owned the organizations were on the floor. They thought that the floor was the best way to do transactions, and that it would always remain that way. And essentially, as of course we saw an inflection point, 1998 probably being the key year when things flipped in the bond market from Life to Eurex. And then that was just the leading edge of the avalanche that followed.
Yes, it was a very, very exciting time in that sort of 1998 through to 2000. It was also quite entertaining because what I remember was in 98, people got scared because they saw what happened. In 1999, we had, let's face it, I mean, there was all sorts of uprisings. I mean, Scott Gordon was elected as the compromise chairman of the CME because they couldn't decide on whether they wanted to have another term for Jack Sandner or Leo Melamed, et cetera, et cetera. And I mean, the whole marketplace was effectively breaking down. People were absolutely terrified. And then we got to sort of 2000 and they started seeing the green shoots of electronic trading work for them. And they all thought, wow, this is absolutely incredible. We can make a fortune. And that's so fascinating when, genuinely, I think it's a great insight that you were the Streetwise Professor when you were pointing out the benefits to electronic trading in a quantitative fashion. So if we take that, I mean, you look at the world of electronic markets. One of the things that fascinates me is the way we've gone from essentially very simple benchmarks in the course of the 80s and 90s through to this multipolar, fragmented benchmark today. I mean, you look at oil, for example, where traditionally with West Texas Intermediate and Brent crude, which are very interesting oils, although at the same time they're almost precisely not the kind of oil that all the people who have oil in abundance actually have, like in Borneo or Saudi Arabia, places like that. How do you view this world where electronic trading has driven all manner of benchmarks and all manner of product expansion?
Well, so I think there's sort of two aspects to that. The one is that, yes, so basically one of the things that electronic trading has done is it's made it much easier to list products. So essentially the marginal cost of listing an additional contract is close to zero. It's not like you're going to take up floor real estate, blah, blah, blah. So it's easy for exchanges just to basically say, hey, we'll throw this out there. And if we build it, if people come, that's great. So what I think it's done is that, still, if you look at in the commodity space in particular, still WTI and Brent, despite what you note as the sort of their legacy and in somewhat sort of an anachronistic characteristics, still dominate in terms of volume, and that's just the sort of the old liquidity attracts liquidity story. And particularly for something like oil, where you have open interest, maybe going out in decent amounts, 5, 6, 7 years, it's really hard to sort of move the market off of that. But the electronic trading has created the opportunity for a bunch of products that are complementary to and sort of specialized and allow market participants to sort of mitigate basis risk by trading in products that are more tailored to their specific needs. So I think that that on the one hand, electronic trading really hasn't change the fundamental tipping aspect and centripetal forces that tend to lead trading to concentrate in a relatively modest number of benchmarks, but it has allowed for the proliferation of products around those benchmarks. And so sort of a more sort of diverse ecosystem. And that's and so I think that's the electronic trading is worked in both of those dimensions.
So that's very interesting. But of course, I mean, you mentioned, and it is a good point, despite the fact that we've got Murban crude, that we've had Spymex and St. Petersburg create Russian crude, which is obviously somewhat of a tricky issue to trade if you don't happen to be in Russia these days. But there are so many other benchmarks have opened up, which is fascinating. However, it hasn't all been plain sailing in West Texas Intermediate. What did you think about what I call the Cushing crisis when WTI prices suddenly went negative a couple of years ago?
So I think it's actually worthwhile to go back, because in some respects there was a sort of a Cushing crisis in the 2012-2015 period, where Cushing really became disconnected from the world market. And essentially what happened is that because of the shale boom in the United States, oil production became completely out of position relative to the infrastructure. So we had a big increase of production in the mid-continent of the United States, and the oil needed to go south, but all the infrastructure was oriented towards bringing the oil north. And so basically Cushing, which was on the north side of that bottleneck, became disconnected from global crude markets. And so this was a subject of a lot of criticism. But then, so market prices send signals, people responded to the signals. And then, the infrastructure issue was essentially eliminated, and Cushing became more connected with world markets again. Then you move forward, and so actually things, say 2015 through 2020, WTI, Cushing, the CME, CL contract were doing very well, and everything looked fine. Then we get to April 20th, 2020, and so in my view, so first of all, the underlying background conditions where you go in, where because of the COVID crisis that had just begun, demand for oil cratered. Supply of oil is not as responsive. You just can't turn off a well like you can turn off your faucet. And so that meant, well, demand goes down, supply stays the same. We need to store more. Even though after there had been sort of a storage crisis at Cushing in 2008, 2009, even though storage had expanded by a factor of about 2 after that, that was overwhelmed by what happened. And so there was a concern that there wasn't going to be enough storage. And as the contract then moved into liquidation, then I think that so you had a sort of a very fraught situation where there was potential for bottlenecks to really impact the price of crude oil. In this case, a storage bottleneck. And then I think that was exacerbated by shall we say, strategic trading by certain market participants. And this was something that was covered relatively extensively in a Bloomberg article, where some traders out of London were, they bought a bunch of TAS and they sold a bunch of crude oil during the day in a situation where the market was going to be very sensitive to order flow. And I think you put those factors together, and that resulted in the negative oil prices that prevailed on the 20th.
So do you think there was in any way a blame that could be thrown at the door of the CME for continuing with Cushing settlement? I mean, lots of the OTC market, if I understand it, has been settling in Houston for a long time, for instance.
Well, yes, but even so, it's been settling in Houston to some degree, but still a lot of that is basis, Cushing. So Cushing is still the price beacon, and that's one of the things that the addition of these other contracts has done, that you can trade basically basis contracts, and that has led to sort of settlement changes in physical oil transactions, but still Cushing is the pricing, the underlying pricing beacon, and people ICE and I think CME have also introduced Houston delivery contracts, and in terms of volume take-up, they really haven't done that well. So yes, there's settlement, on a lot of physical trades based on Houston prices, but indirectly, those are still driven by Cushing.
Very interesting. Now, changing gear a little bit, obviously one of the things that came after the electricity markets was the gas markets and so on. And we've seen some quite fascinating ramifications recently of Russia's invasion of Ukraine, with the European Commission and the European Union suddenly deciding that there must be price caps. I happen to think it's a little bit, how might one put it, Canutian in the fashion of King Canute, trying to turn back the tides. But what do you make of it, and what do you make of ICE's proposed settlement of 2 contracts, one in London that's free and one in Amsterdam that's under the price cap?
Well, so yeah, the whole price. So the whole price cap episode is rather interesting, because it's clear that within Europe there was sort of a more Jacobin kind of group of countries that wanted to put on a real price cap, which would have been really Canutian or Justinian-like, or go back to the price caps of the Emperor Justinian. But the Germans and the Dutch in particular said, we've been down, the world has been down that road many times. It's a recipe for disaster. And so they came up with this sort of compromise price cap mechanism that in some respects looked like it was designed not to be binding. And one interesting thing about it is that it only, the price cap was only operative on the futures markets. It was not operative on the underlying physical price of gas. And also the things that would trigger the application of the price cap. You think about it, it was sort of like a Parisian option, right? So you basically had to have the price be at the be above the barrier for a certain amount of time before the price cap kicked in. So all of those things, and then they got lucky. The winter has been, maybe I should say you got lucky. The winter has been relatively mild in Europe, and so gas prices have backed down a lot. So on the one hand, the fact that it was only applying to the futures market meant that sort of the potential damage of price controls would have been contained, but still, you think about the impacts on margin, think about the impacts on people being locked into positions, or people saying, "Oh my God, the price cap's going to cut. I won't be able to get out of my position, so I'll liquidate now," and all the potential chaos that can be associated with these kinds of price limits. That was pretty negative. And ICE basically quite reasonably said, "Hey, this is you're putting an incredible risk on us." And post Brexit, there's a place that we can go, not too far away, give ourselves an out. I haven't really followed how, so would they transfer open interest and all those sorts of things? But it was, clearly an understandable self-preservation move by ICE. And also, I think it was ICE firing a shot across their bows saying, if you're thinking about this kind of stuff or even worse in the future, we can be out of here. So.
Yeah, I think that's a very good summary altogether. Quite fascinating that they would apply something to a futures market, not the underlying cash. And there's so many get-outs that just make it look like such a mess. Yeah. Certainly, thank you very much. Let me also add at this juncture, while we're chatting with the Streetwise Professor, Dr. Craig Pirrong, Marianne Madeira making a comment. Great to see a Streetwise Professor in IPO-VID. Thank you very much, Marianne, for your kind comments. So, it is interesting. I mean, you look at the energy market ramifications around the world, and it certainly feels at the moment like governments are itching to try and protect prices. But it seems to me that becomes increasingly more difficult because actually the futures markets have shown so much liquidity on market pricing of so many instruments around the world.
Right. No, absolutely. And that's, and in some respects, trying to, it's, a lot of this is an attempt to shoot the messenger, right? So the messengers are the markets, and they're providing the information about, the fundamental situation is this: the commodity is scarce, and it should sell at a high price. And politicians, legislators, regulators, and things of that nature frequently don't like the message, and so they look for ways to stifle the messenger. I think if we've been fairly fortunate so far that the European initiative, as sort of tentative as it was, is really the only serious measure we've seen, with the exception of sort of the price caps on Russian oil and, as of this week or last week, Russian refined products. Has potential to be destabilizing and create all sorts of havoc as well.
Yes, it's interesting. I mean, talking about obviously the Russian situation, which is driven by Ukraine, but the European Union seems to be getting remarkably almost messianic, not merely Jacobin, about the way that it's trying to treat markets these days. And I don't know if you do much research on it, but I'm interested to hear your thoughts or any input you have on the whole clearing debate, because every time the European Union speaks, the media are convinced that that's it, that London's clearing business and the rest of the world's euro clearing business disappears. And yet, after 2, 3, 4 sorties so far to try and take that business, still post-Brexit, London is winning.
Yeah, well, so a couple of things about that. So, so that episode I've done a lot of research on clearing over the years, and that actually stems back to that episode on October 19th, 1987, because the 20th, I went into the CEO of my FCM's office and I said, "Gee, Brian, you look pretty bad." And he says, "Well, I didn't sleep last night." And I said, "Well, why didn't you sleep last night?" He says, "Well, the clearinghouse almost failed." And that was sort of a revelation to me about, sort of the reliance of the industry, not just the futures industry, but sort of the world financial markets, to the plumbing of the clearing system, and also some of its vulnerabilities. So I've done a lot of work on clearing over the years. That really picked up after the financial crisis, when clearing was deemed to be the, sort of the silver bullet that would prevent future financial crises. And I was something of a Cassandra, where I was saying, well, you look at things like October 19th, 20th, 1987, you look at some other episodes, clearing can actually be the source of financial market instability as opposed to the cure. As part of that research, one of the things I looked at was, well, let's look at the organization of the clearing industry. And one thing that is definitely true is that there are substantial economies of scale and scope in clearing. And so, this is an industry that will inherently be dominated by a relatively small number of large and diverse entities. And so in some respects, so what the Europeans, EU wants to do and the EC wants to do is essentially really fight against the fundamental economic considerations that tend to sort of lead to entities like the LCH being dominant. And also related to a point that I made before about sort of having open interest that goes out a long time. It's really hard. So even if you move the flow, moving the stock is really hard. And if you can't move the stock, then the flow doesn't want to move. And so, so they're being trying to be like Canute too, in essentially fighting against the fundamental centripetal forces and the advantages of incumbency that exist in clearing.
Fascinating. So let me ask you to speculate. Do you think the European Union can make any progress in moving clearing business into the Eurozone away from London and indeed New York?
Well, so you have to think about the political economy of the situation. So clearly there are entities within, political forces within Europe that want to make it move. But also, on the other hand, I think market participants are far less enthusiastic about that, even EU domiciled market participants. And so, yes, I think that there are things that Europe could do to essentially compel this, but whether they will do that is much more open to doubt because of these political economy considerations. The clearing is where it is because it's efficient, it's cheap for people, so they say, well, we're going to move it, we're going to fragment it. The fragmentation creates costs. The loss of economies in scale and scope increases costs. And so from a market participant's perspective, their loyalty is to the bottom line, not to a boundary line. I think that that's one thing that will mean that this was kind of a debate that will go on and on and on and on. But I doubt that Europe will find the intestinal fortitude to really force it.
Very interesting. The Streetwise Professor, Dr. Craig Pirrong, drawing out a lot of fan mail as well this evening. First it was Marianne Madeira. Now we've got Angie Steers. Good evening. All honoured to hear and see Professor Pirrong speak. Well, absolutely. So are we here. It's making an epic IPO-VID 93. Thank you very much, Anya, for your input. Now, the interesting thing about the clearing business that you mentioned, one thing is, as you said, I mean, clearing is a skill business, so therefore everything tends to go to larger, better capitalized players. But it's interesting to look at the developments over, say, the period from 1987, because at that point in time, just about every man and his dog had a clearing operation, even in the big markets in Chicago. And nowadays, we've really seen that pared down to a relatively modest oligopoly. Do you think that there is an issue ahead because there simply are not enough clearing members around?
Well, so there are two. So the one issue is clearing houses. The other issue is clearing members. And so I would sort of reframe the issue a little bit differently, and that's as follows. So one of the again, as I noted before, one of the reasons that for the Pittsburgh Declaration in 2009, I guess it was, and then Dodd-Frank, and then MiFID II and all that stuff, was that basically clearing was going to be a panacea to prevent systemic risk or reduce systemic risk. And one of the things was, you look at the big banks and the OTC market, it's so concentrated, and that concentration creates risk. Well, now we have risk concentrated in a handful of clearinghouses. So I don't think that from a concentration perspective that things have really improved. Also, but then the other issue is FCMs, and that's I think one of the great unappreciated or underappreciated stories of the past couple decades, which is the incredible consolidation and concentration in the clearing business around the world. So again, going back to my days, my Sal days, when I was in grad school working at FCM, there are dozens of small and medium-sized FCMs in Chicago and New York and London and so on. And now, essentially it's dominated basically by the big banks. And so, so that's been, sort of a major development. And it has all sorts of ramifications in terms of systemic risk, in terms of competition, and things of that nature. So, it's been a sort of a fascinating case study in the evolution of industry structure. And I think that there's sort of a complementarity between sort of the move to clearing and also the dominance of a relatively small number of bank FCMs. That's like I say, I think it's been really underappreciated in terms of how big a change that's been, and I don't think that the consequences of that are fully understood yet, by me including.
Yeah. I'm in heated agreement with you once again, Craig, because I think it's a fascinating issue, because as you say, in 1987, every man and his dog, small banks, medium banks, good grief, one of the biggest clearing members at the Chicago exchanges in 1987 would have been somebody like Northern Trust through their futures arm. And I mean, Northern Trust was barely able to scrape into the top 500 banks in the world. I mean, no disrespect to it. It's a great bank, and it's been a very well capitalized bank over time, but it is just a small Midwestern focused bank. Admittedly, it's become a mega player in custody in the equity market and so on over time. But yeah, it's incredible how that whole thing has changed. And I think people aren't really paying attention to the ramifications of that market. Let me just break off there while I'm chatting with the Streetwise Professor, Dr. Craig Pirrong. I am Esmeralda. Good evening. It's lovely to see you once again. A great guest you have, Patrick. Another terrific IPO-VID episode. Well, you're stacking up the fan messages this evening, Craig, and rightly so. Now, let me ask you about something else while we're at this, talking about CCP clearing houses. A year ago, there was a guy in short trousers, quite literally, who went to Washington and decided that he was going to rebuild the whole world of clearing. And in what amounted to the most incredible, I think, hyperinflationary year this side of the Weimar Republic, or possibly Zimbabwe in recent years, he thought he could rework the whole of central counterparty clearing with $250 million as being the amount of collateral. And by the time we got to the end of the year, it was $250 million, admittedly hypothecated in a very odd way. But nonetheless, it was $250 million was actually on the ticket stub for his bail by the time we got to December. So tell me a little bit about your interaction with FTX and what you thought about the whole thing and their clearing proposal et al.
Well, so my involvement was, thank God, was as an observer. So I'm untainted by any, contact with SBF or, his girlfriend or any of that sort of stuff. His psychiatrist, there was an article about that in the Wall Street Journal the other day. So I was an observer and I was a skeptic. And so, I mean, the thing that took me sort of by surprise was the sort of the messianic reaction that people had to him and his idea, and they didn't really, ask the pertinent questions. And it's sort of shocking to see the way that you get so much deference from CFTC commissioners, and there's all sorts of stuff about meetings, etc. So I was quoted in the Financial Times, wrote a blog post that Financial Times reporter called me about it, and I was quoted in the Financial Times, almost a year ago. So it was end of March, I was a skeptic. And so what was his model? His model was essentially to disintermediate clearing. And so now you trade through a futures commission merchant or a clearing broker, and you don't have a direct relationship with the clearinghouse. There's a sort of a flow of margins between the customer to the FCM or the clearing firm to the FCM and back. And so and that's based on margining. That's usually daily or sometimes intraday for clearing members. And so what he had was this idea: we're going to have direct clearing. And you think about, well, what's the idea behind clearing? Clearing is supposed to be a no debt, loser pays system. And so how is he going to make it a no debt, loser pays system where individuals had access to the clearing system? Well, that was basically going to be on real-time margining, and essentially that market participants, if price moved against them, they would have to basically margin almost immediately, and if they didn't, then their positions would be liquidated. And I thought that was like automating a doom loop. And then one of the problems with margining generally and clearing in particular is that margins can be an accelerant of instability. And this was essentially automating that. And so okay, fine, if you do it in crypto, whatever. But the thought of moving that model, as people were talking about, moving that model to the incumbent markets, the standard markets and derivatives, or cash equities or so on, I thought that was just insane. And so I think it's somewhat fortunate for the world that other factors caused FTX and SBF to blow up before their bad idea infected the broader financial ecosystem. So I think we really sort of dodged a bullet there, to mix metaphors.
I think we dodged a bullet big time, and I agree with you. It was incredible watching the craven response of certain parties at the CFTC, and they were looking across the table to the head of regulation at FTX's US subsidiary, at least, who was formerly one of their number as a commissioner, and thinking, my goodness, this man's hit the big time. And as we know, he had at least 2, I think, drop shipping accounts in his name via the FTX creditor list, if you've been looking at that recently. But it was quite incredible. What struck me was, and your points are very well made about the whole point of margin can be an accelerant to instability. It struck me that the system they built was the absolutely, I mean, it was the perfect whipsaw market for aggressive local type trading. I mean, it was Chicago in, essentially it was the worst of Chicago locals,
Right.
if you didn't have a kind of a policeman
Right.
that was sitting there. And let's face it, we know every contract has, you know, that sort of person. You just beat the locals back into line. Go ahead.
Right. Well, so I mean, so that one of the thing, another thing I said in the blog post is that well, you look at what was one of the sort of the classic sort of manipulative tactics on the floor of the exchange, gunning the stops. Right. So
Yep.
you know where the customer stops are. You have an idea where the stops are. You trade a big volume, trigger the stops. That causes the market to move further. You cover and make money. Well, this was basically a great. I mean, this was so basically every order was a stop order in essence.
Yeah.
And so it would, just like you said, I mean, it would create a tremendous opportunity for really aggressive traders to basically be able to game that system and inject additional volatility into what's already a volatile instrument.
And you may well have been ahead of the curve on this, but the thing was, I came to that conclusion, and then it was a few months later where I started reading about Alameda Research, and I began to realize that actually there they were operating the exchange, they had the casino, they had their own market maker who effectively had a great deal of knowledge and information and priority to trade and no margin. So therefore, they built the local whipsaw profit engine into the whole system.
Absolutely. And there are no coincidences, comrade, So.
Yeah. No, I agree. I mean, I thought it was just incredible. And actually, I mean, on that topic, I'm going to come just a second to a question from Jeff Cutler. But first of all, we got a lovely remark from Ruslan Ankoy. Hello, Ruslan. I do believe this is the first time you've been watching the show, or at least first time we've seen you commenting on the show. Let's put it that way. Very interesting story by Professor Craig Pirrong. Thank you very, very much. Let's go to someone who's going to be a guest actually in a few weeks' time. It's Jeff Cutler, the journalist. He has a lot of strings to his bow over the course of the years: American Banker, GARP, the Global Association of Risk Professionals, Tab Forum, and more. Hello, Patrick. Hello, Jeff. Does the Streetwise Professor believe that the crypto phenomenon is worthy of the same intellectual and analytical firepower that he directs to other subjects and asset classes?
Yes, I have written some on crypto and blockchain generally, because there's been talks about blockchain and widespread application of blockchain to finance, and so I think it's worth analysis primarily because it is a phenomenon. We can't dispute that. It could have wide-ranging ramifications, and it's very poorly understood. So I think as a relatively new field, sort of the marginal value of research effort to understanding the way the market works and understanding the implications between the interaction of crypto with the broader financial markets is definitely worth more attention. And I do plan to put attention to that. In terms of, so I think there has been a sort of a lot of frivolous, shall we say, research on, sort of the price behavior and things of that nature in these markets. But I do think that there's given the serious potential for crypto to have big impacts on the markets, and not just the crypto markets, but all markets, to devote some intellectual effort to understanding it better.
Fascinating altogether. And I must say, actually, if you have not read it, even with the benefit of hindsight, it is fabulous to read your post from last March, the blog post where you took apart the FTX CCP proposals, because it really, really did lay bare something that was there. And we ran it in Exchange Invest, a link to that, as we do with many of your posts, because it's always great to hear from the Streetwise Professor when you're talking about our markets. So Craig, I mean, I'm very, very curious. Thank you once again, Jeff, for that question. Much appreciated. Just as we enter into the last 10 minutes of our show, I'm curious. I mean, it seems to me that in one sense, lots of things have progressed, lots of things have improved, yet we still get these amazing blowouts, blow-ups happening every so often around all of our markets. The Cushing crisis, the nickel nightmare, FTX. Is that just history is going to constantly repeat itself no matter how safe we make things?
Yeah, so so a couple aspects of that. Yes, I mean, so it's so the engraving behind me is a picture of the gold exchange floor on Black Friday, 1869. And maybe that was one of the first big market blowups, but the 100 and 53 years since has seen periodically these sorts of things, and I don't ever think that we're going to banish them. And and one important thing I would like to argue is that in many cases, the things that we have done to supposedly make the market safer has just created new vectors for problems. And famous economist Hayek said something to the effect that it's the curious job of the economist to point out that things that people can't design the things that they think that they can create, and that there really has to be an incredible degree of humility in talking about how you can try to engineer these incredibly complex and interconnected structures without introducing new sources of danger.
Yes, introducing new sources of danger. And I suppose that brings us elegantly to this week's headline technology story, an Ion Group getting hacked.
Yeah, so that's an example. So you talk about the electronification revolution, the computerization revolution. Essentially, Ion has been a creation of that and a facilitator of that. But what has that done? It's created a particular potential source of danger, which is cyber attack. In this case, a ransom attack. And again, due to the tremendously interconnected nature of financial markets, you take down one piece, it has ramifications far beyond that particular piece.
Yeah, it's quite incredible. So really, in many respects, I mean, you talk about the Jacobins earlier, but the thing about this is definitely plus ça change, plus c'est la même chose when it comes to meltdowns, problems. There always seems to be something new on the horizon that can manage to be done. But nonetheless, I mean, the futures markets of today, the options markets of today, they are quite spectacular success stories in their own right.
Absolutely, absolutely. Incredible stories. I mean, I thought that they were remarkable when I got into the industry, 37 years ago, and I mean, now they've expanded even way beyond that. I mean, it's been as a scholar, and as a market participant, it's just been incredible time to be a student and a participant in these markets.
Yes, it's been absolutely incredible altogether throughout that period of time. And while we both happen to be advocates for electronic trading, I must say I do miss the idea of an old-fashioned, good old thronging floor. There was something spectacular, like a steam locomotive.
Absolutely. I mean, so in my class, I play videos. I mean, so even though it's not a current event, it's not really sort of knowledge that they can directly use. I have a sort of a romantic, sort of soft spot for the floor, and I do miss it.
Upon which note, therefore, we miss the past. We're certainly reminiscing about how wonderful floors were. But where do you think, Streetwise Professor Dr. Craig Pirrong, the capital market revolution goes next?
Well, if you're of my age or thereabouts, you might remember there was a Gil Scott-Heron composition called "The Revolution Will Not Be Televised." And so my perhaps somewhat provocative reworking of that is that the capital market revolution will not be decentralized. That centralization of exchanges, of clearing, et cetera, will continue to be the dominant paradigm for the foreseeable future.
Centralization is going to stay in. Good grief. I made a remark to that effect, the other week in Dubai, and I thought I was about to get lynched by one part of the audience. Admittedly, it was a crypto conference, so I knew I'd walked into the lion's den at the time when I started it, but I hear you. I think that's a very, very interesting and thought-provoking comment upon which we can look to the future, and also we can manage to analyze the possibilities in this endless world of opportunity. Dr. Craig Pirrong, the Streetwise Professor, it's been a joy. The hour has just flown past, and I think we can manage to carry on well into your afternoon without any difficulty whatsoever. I really hope we'll get a chance to catch up again at some stage, even just to hear some of the snippets about things that are happening in markets. Thank you very, very much for your time today on IPO-VID 93. Thank you also to all of our commenters, Chris Messina of Messy Times, John T, Peter Secon, Les Calvert, Marion Madeira, Anya Steers, I Esmeralda, Richel and Ancoy, and Jeff Cutler. We're going to be back on next week. It's going to be a Valentine's Day meeting of minds on the distributed ledger. We're going to be talking to South Africa's foremost expert in the clearing and settlement of securities before she became a blockchain advocate. And that's why it's going to be fascinating to hear from Monica Singer, who's going to be talking about straight to the blockchain. That's going to be next Tuesday at 7 p.m. Hope it hasn't been too much of an echo for you this evening, because actually it happens to be that we're in the process of moving house and all the furniture has been taken away during the course of this afternoon, apart from the seat that I'm actually sitting on at the moment. Thank you very, very much for watching. This has been an epic IPO-VID 93. Once again, great episode talking to the Streetwise Professor, Craig Pirrong. Thank you very much, Dr. Pirrong. Look forward to seeing you again next week, ladies and gentlemen. Have a great week in blockchain, life, and markets.
Thank you.